Welcome, everyone. Today we're covering Chapter 11 and Performance Measurement. This chapter is very important because it focuses on how managers evaluate business performance financially and beyond the financial numbers. Financial performance is important, but it is not the only thing that matters. By the end of this chapter, we should be able to explain the concept of responsibility accounting and performance evaluation, describe how a business evaluates cost center, revenue center, and profit center performance, and compare return on investment and residual income methods for evaluating investment center performance. Before we begin, let's connect performance measurement to real life. Do you ever set goals, exercise goals, or health goals? How do you track how well you did relative to those goals? Committing to exercise transforms health and well-being. Despite initial challenges, improved energy, weight loss, mental clarity, better sleep, and reduced cholesterol highlight its value. Reclaimed vitality and happiness make the effort a rewarding, life-changing investment. Let's review. This slide reminds us of what we learned in Chapter 10. Variance analysis compares actual results to budgeted expectations. Controlling costs is one way to improve profits. And we learned in Chapter 10 to effectively evaluate how well a business controls manufacturing and production costs using flexible budgeting principles and variance analysis. The two concepts are useful ways to compare actual production cost differences with expected production costs. Performing a meaningful analysis requires setting a common basis from which to perform comparisons. Now let's do Learning Activity 11.1. Single Shot Coffee produces a single-serve coffee cartridge that is compatible with most single-serve coffee makers. Consider Single Shot's expected production volume and overhead cost assumptions. Using that information, finish computing the January manufacturing overhead budget, assuming Single Shot uses flexible budgeting principles. Let's look at Learning Objective 11.1 and explain the concept of responsibility accounting in performance evaluation. Responsibility accounting involves gathering, analyzing, and reporting costs and revenues directly under a manager's purview. Control refers to the capacity to make operational decisions affecting costs and revenue. Responsibility accounting separates controllable from non-controllable costs and revenues. Managers are evaluated only on what they can control. For example, a sales manager's performance is evaluated on sales generated and direct costs, not profitability. In a decentralized company, we often have responsibility centers. In decentralized companies, control is delegated to various managers. Managers oversee distinct responsibility centers impacting specific accounts. Responsibility centers include cost centers, revenue centers, profit centers, and investment centers. Let's do Learning Activity 11.2. Match the term related to responsibility accounting with the appropriate definition. Pause your video and complete the exercise. Then review your answers with the solution provided in the back of Chapter 11.